Warren Buffett was born in 1930 in Omaha, Nebraska, into a modest but hard-working family. From an early age, he displayed a fascination with money and numbers that set him apart from other children. At just 6 years old, he was selling packs of chewing gum to neighbors, carefully calculating profits and reinvesting them. He also sold Coca-Cola bottles and weekly magazines, not merely to earn money, but to understand business and value. Unlike most children, Buffett was obsessed with learning how wealth could grow, observing every transaction and imagining how small actions today could create bigger results tomorrow. His parents encouraged his curiosity, and he absorbed lessons about saving, investment, and responsibility like a sponge. By age 11, Buffett made his first stock purchase, $38 in a company called Citi Service. He watched the stock rise and fall, learning an invaluable lesson in patience and market psychology. Unlike many who panic at the slightest fluctuation, he learned to focus on the long-term potential of an investment, understanding that short-term market swings were often irrelevant compared to a company's intrinsic value. That early experience would shape his approach to investing for the rest of his life. Buffett's teenage years were filled with entrepreneurial experiments. He delivered newspapers, sold stamps and coins, and even bought a pinball machine to place in local barber shops, collecting quarters from customers. Each venture taught him lessons in marketing, customer behavior, and reinvesting profits. While his friends spent money on toys or entertainment, Buffett reinvested his earnings, allowing his capital to grow steadily. His habits of saving, reinvesting, and researching became the foundation of his lifelong financial discipline. Education played a crucial role in shaping Buffett's approach to wealth. He attended the University of Nebraska and later Columbia Business School, where he studied under Benjamin Graham, widely regarded as the father of value investing. Graham's philosophy resonated deeply: invest in companies whose intrinsic value is higher than their market price, focus on long-term growth, and avoid speculation. Buffett embraced these principles rigorously, understanding that disciplined research and patience were far more powerful than chasing quick profits. In the 1950s, Buffett began his first investment partnerships. He pulled money from family and friends, applying his growing knowledge to real-world investments. Every decision was carefully analyzed, considering a company's earnings, management quality, and competitive advantage. He avoided investments he did not fully understand, believing that clarity and discipline were more important than excitement or hype. These partnerships grew steadily, and Buffett's reputation as a thoughtful, disciplined investor began to spread. Buffett's temperament distinguished him from other investors. He remained calm when markets crashed, often seeing opportunity where others saw only fear. For example, during the 1973-1974 stock market crash, he purchased shares in fundamentally strong companies at bargain prices, profiting enormously in the following years. His patience and discipline proved that financial success was less about luck and more about strategy, long-term thinking, and emotional control. As his wealth grew, Buffett made some of the most iconic investments of his career. He bought Coca-Cola in the late 1980s, recognizing a strong brand, consistent earnings, and loyal customers. He invested in American Express during a crisis, understanding the long-term potential of the company. Each investment was chosen not for short-term gains, but for sustainable growth over decades. His strategy relied on compounding returns, the principle that earnings reinvested generate more earnings, growing exponentially over time. Buffett's lifestyle also contributed to his financial freedom. Despite his immense wealth, he lived frugally, residing in the same Omaha home he bought in 1958. He avoided luxury for the sake of status and instead prioritized learning, investing, and philanthropy. He demonstrated that financial freedom is not measured by extravagance, but by control over your money, choices, and long-term security. His story is not just about wealth, it is about habits, mindset, and resilience. Buffett read thousands of pages every day, analyzing financial statements, understanding market trends, and continuously improving his knowledge. He avoided impulsive decisions, prioritized companies with strong fundamentals, and trusted in his long-term strategy even when others doubted him. Every market crash or economic recession became an opportunity to learn, adapt, and invest wisely. Buffett's philanthropic efforts further highlight his approach to money. He pledged the majority of his fortune to the Gates Foundation and other charitable causes, proving that financial freedom can also be used to create impact and leave a legacy. His life illustrates that wealth is a tool, not just for personal gain, but for making a difference while maintaining control, discipline, and long-term vision. Through decades of careful investing, disciplined habits, and continuous learning, Warren Buffett exemplifies the essence of financial freedom. His journey shows that anyone, regardless of background, can build wealth with patience, knowledge, and smart decisions. From a boy selling gum in Omaha to the head of Berkshire Hathaway, Buffett's life is a roadmap for those seeking long-term financial independence.